It's Thursday, January the 20th. Good morning and welcome to Business Morning. I'm Chimeze Obi Iwago.
Thank you for joining us. I am BC Adebayo.
Well, a total of about 647.4 billion naira from the Federation account revenue for the month of January 2020 has been shared between the three tiers of government. Total amount comprised statutory revenue, value-added tax, exchange gain, non-oil revenue and excess bank charges recovered. It was also announced that as at February 19, 2020, the balance in the excess crude account was $71.814 billion. The gross statutory revenue for the month of January 2020 was 525.253 billion naira. This was lower than the 600.314 billion naira received in the previous month by 75.061 billion naira. For the month of January 2020, the gross revenue available for the value-added tax was 104.758 billion naira as against 114.805 billion naira in the previous month, resulting in a decrease of 10.047 billion naira. From the total revenue, the federal government received 267.389 billion naira. The state government received 176.923 billion naira, and the local government councils received 132.94 billion naira. The oil-producing states received 46.197 billion naira as 13% derivation revenue, and the revenue-generating agencies received 23.900 billion naira as cost of revenue collection. Well, in the meantime, the Department of Petroleum Resources has warned that Nigeria's crude oil reserves of 37 billion naira will be depleted in 49 years. The reserves, which stood at 37.45 billion naira in 2014, fell to 37.06 billion barrels in 2015 and 36.74 billion barrels in 2016. It, however, rose to 36.97 billion barrels in 2017 and 37 billion barrels in 2018. The reserves depletion rate is a measure of 2018 total oil and condensate production divided by the reserves as of January 1, 2019. Well, the DPR said this indicator gives a bird's eye on an annual basis what percentage proportion of the quoted reserves was received. According to the regulator, to achieve the government's aspiration of 4 million barrels per day production and reserves of 40 billion barrels, there is a need for corresponding increase in reserves as production increases. And the poor state of electricity supply in the country is one of the issues that again got the attention of the Federal Executive Council at its weekly meeting presided over by President Muhammadu Buhari. Going forward, the federal government may review the performance of electricity distribution companies and take appropriate action to improve power distribution. The Minister of Power, who made a presentation on the matter to the council, says the country generates 13,000 megawatts, but only 3,000 is taken by the distribution companies, adding that even at that, the discos are unable to pay in full.
Most of the problem we are facing today in this country that we cannot get electricity supplied adequately or efficiently, it is because we have a problem in distribution. Generation, no much problem. We can generate up to 13,000, I said. But the transmission, those who are taking the electricity supply, can only take 7,000. And even at that, they are not collecting the 7,000, they only collect 4,500 and then send to distribution. Distribution now receive only 3,000 and they pay for only 1,500, just 15% of what they are collecting. So government are now completing. Government have to fill in the gap. So we cannot continue like that. We have to take a decision. If they are ready to continue, fine. If they are not ready to continue, maybe they should give way to investors or whoever that is ready to come and invest.
Well, and to the markets, yesterday we saw a heavy sell-off of GT Bank stocks, and that pushed the index further down into the red by 0.1%. Well, let's get details from BC.
Absolutely, Chimi.
Right, go ahead.
Well, just like you mentioned, sentiments remained weak in the domestic markets yesterday. Of course, we saw the benchmark index decline by 0.09% to 27,523.08. Of course, that was driven by sell-offs in the shares of GT Bank, just like you mentioned, Jimmy. Now, consequently, the month-to-date loss increased to 4.6%, while the year-to-date gain moderated to 2.5%. Well, total volume of trades increased by 72.6% to 290.15 million units, and that was valued at 5.02 billion naira, exchanged in 3,528 deals. Losses were seen across all the sectors except the industrial goods index, and that gained 0.46%. The banking index was down 0.55%, and that was driven by losses recorded by FGN Holdings, GT Bank, just as we mentioned earlier. Jaiz Bank also declined, as well as Wema Bank. Now, all of that contributed to the banking sector's loss on Wednesday. And the consumer goods sector was down 0.15%, as you can see on the screen. And we only saw losses in the share price of Dangote Sugar in that sector. For the insurance sector, now, that index took the heaviest hit of 2.29%, and that was driven by losses recorded by Custodian and Allied Insurance, Law Union and Rock, Mansard Insurance, and WAPIC. Now, the oil and gas sector also closed negative, and declines were seen in the share prices of Forte Oil and Wando. All the other stocks on that counter remained unchanged, just as you can see on the screen. And turning away from the stock market now to the NESD OTC market. Of course, there was a bit of increased activity there. That index was 0.39% positive on Wednesday, with a market cap of 503.55 billion naira. Volume was seen at over 49,000, and it was valued at 10.76 million naira in 7 deals. And at the fixed income space yesterday, the February 2020 FGN bond auctioned by the Debt Management Office was oversubscribed, it was oversubscribed by 258.2 billion naira. The DMO offered 140 billion naira across 3 instruments to investors at the auction of a 5-year tenor of 45 billion naira, 10-year tenor of 45 billion naira, and 30-year tenor of 50 billion naira. Well, looking at the numbers, the market was bullish as average yield contracted by 7 basis points to 10.1%. 32 deals were recorded at the end of the day, and it was valued at 17.89 billion naira. And at the Treasury bill secondary market, it was quiet yesterday. Obviously, that was caused by the market participants shifting their attention to the bond auction by the DMO. Consequently, yields across all the instruments were unchanged. In all, there were 12 deals valued at 933.3 million. And elsewhere, average yield contracted by 9 basis points to 12.8% in the almost secondary market. And total number of deals there came in at 478, valued at 177.76 billion naira. But we'll wait to see what direction the markets will be taking today, Chime.
Well, we hope it ends positive, and
so.
This bearish trend has really continued for a long time. Now, let's just hope that perhaps pretty soon we'll get to see some kind of positive catalyst that can spur the market. We're expecting the GDP number out by Monday. Let's see if that can actually interest the investors. All right, let's take a moment. We'll be back with a commodities market update. Well, on commodities market update, quite a number of headlines making the list of FDC's burning economic issues, including the UK's inflation rate, which was reported yesterday to have gone up to a 6-month high of 1.8%. Just wondering why this is making the burning economic issues here. Any implications for Nigeria? Temitope Olubile, a research analyst with Financial Derivatives Company, will, of course, explain all of that to us. Thank you, Temitope. Thank you for joining us on the show.
Thank you for having me.
Now, you have UK's inflation as one of your burning economic issues. How would you relate the implication of UK inflation rate to Nigeria's domestic commodities market space?
Okay, so looking at it, I mean, UK's inflation is still way better than what our inflation is currently. So to how it affects Nigeria, so we have the UK is one of our trading partners, but it's not necessarily a leading trading partners because that is reserved for like China and the Netherlands. But, you know, so it wouldn't really have an impact on our imported inflation, not that much of an impact. But when we look at what's happening in the UK currently, we have that, you know, they're done, well, the Brexit, you know, uncertainty is starting to, you know, ease because, you know, they've done the things they need to do, right? But so we have that, you know, there's expected to be a rebound of, you know, business confidence. So the growth concerns are not necessarily as bad as they were before. But so we have that growth is expected to bounce back, and then we have higher inflation. So that, you know, suggests, or, you know, economic theory suggests that at the Bank of England's next meeting, you know, you could have a hike in rates. And if that happens, you know, we have that, you know, there will be less money for Nigerians in the UK to spend. And what does that mean for remittances? Because we have quite a number of Nigerians based in the UK. So the impact on Nigeria is, you know, the impact it will have on our diaspora remittances from the UK.
Well, let's bring things, you know, back home now. Yesterday, the federal allocation was made to the 3 tiers of government, and of the amounts, we saw a decline of 9.6%. What does this tell us? Okay,
so, you know, this, first of all, we have that the decline in revenue could, you know, be as a result of the decline in average oil prices when you compare, because the money shared in February is based off, you know, January's revenue. So when you compare what oil prices averaged in January compared to December of 2019, you have that there was a decline in average oil prices. But what is more worrying from that meeting, you know, is the state of our excess crude account, the balance on it, right? So we see that the savings in our excess crude accounts depleted by a huge amount, right? And we have that, you know, there's already declining external reserves. We have that Brent is already below $60 per barrel. So that all just points to pressures in our external sector and our increased external imbalances, and that what that could mean for indicators such as exchange rate and, you know, inflation.
Okay, you heard the DPR warn that Nigeria's crude oil reserves will be depleted in 49 years. Yes. Is that a worrisome situation as it is now?
I mean, what that just means is that what they're trying to warn us of is, you know, if we keep producing without, you know, increased discovery, basically you're not refueling your reserves, you know, increased discovery of, you know, oil across the Federation, right?
But the government made a discovery recently in the north. Yeah?
Yes, we had that report. So if you don't keep making discoveries like that, and you're you're depleting the reserves, but you're not filling it back up, then that's what the DPR is trying to say. Then in 49 years' time, you know, your reserves will be completely dry. But, you know, when you look at it, the more worrying thing is, you know, how relevant oil will be in, you know, 49 years' time. You know, we could go into electric cars. You see all this kind of, you know, innovations pointing to, you know, the growing irrelevance of oil in that 49 years' time. So I think what we should really focus on is diversifying away from oil by 49 years' time. Yes, I think that's
well, let's look at another angle now. The bankers' meeting, the bankers' committee at their last meeting agreed to partner with the federal government to bridge the infrastructure deficit. What do you make of that?
Okay, so, I mean, it's just, it's a coming together of, you know, the monetary side from the bankers and, you know, the CBN, and then the fiscal, because by and large, infrastructure is a fiscal problem, right? So it's just a coming together of both teams, monetary and fiscal, to try and solve this problem of infrastructure. You know, some could argue that, you know, the monetary should really be focusing on curbing inflation and should be keeping their eyes on that. But I think it just shows an increased coordination, because you don't want a situation where your monetary team is doing something against what your fiscal team is trying to achieve. So it just shows increased coordination between both teams, and it's good for Nigerians when we, you know, to fix infrastructure problems like your road networks, your rail, power, all those kind of infrastructure challenges we have is good in the long run.
But what about the, implementation of some of these things? I mean, it seems we are all good at coming up with some kind of policies and programs, but when it comes to implementation is a problem. Who monitors these implementation?
So, I mean, it remains a problem. Implementation remains a problem across all sectors. So we can just only hope, because I think the Bankers Committee has said that, they've set up a subcommittee trying to, look at how this will work out, financing, the structure, payment structure and everything. We can only just hope that, the implementation we begin to see. But bear in mind, there's always a time lag. There's always a time lag in these things. So infrastructure is not just going to spring up from the ground. It takes a while before they get the financing structure and before we actually start to see the good sides of these policies.
Well, Temitope, let's talk about yesterday's bond auction by the Debt Management Office. Of course, that was oversubscribed. Now, how will that now impact infrastructure development?
Okay, so, the bond market is really gaining increase buying interest, I would say, since, the OMO restrictions and everything, and because, investors are looking for outlets to put their money, right? So that's why we see that oversubscription happening in the last few auctions, right? And we see that because of this, yields are now declining, and they don't mind the decline in yields, because that's why that also explains the stock market. We've seen that the temporary rally that was witnessed in January was not sustained, right? So it just shows that investors are willing to take less from the yields. They're willing to take lower yields, because there are no too many outlets. So if we have outlets like the real estate, if we're sure that, real estate is a good outlet, the stock market, we have this kind of out, then we'll have other, you would see portfolios, you see them spread their portfolios across outlets, but because of the very few and, very challenging outlets we have, that's why we see that rush to the bond market.
And what would all of these mean for the commodities market?
Okay, so I mean, for the commodities market, it just shows that in terms of infrastructure, when you build your infrastructure, when you develop your infrastructure, you see more output, right? And then you see more, you can have more demand. And so when you have more demand, you get increased prices. But by and large, so it's really, you're fixing the infrastructure problem, but then what happens to your commodity prices? But I think we would rather prefer good infrastructure, good roads, to, bad roads we're currently experiencing.
All right, thank you very much, Temitope. Well, let's just hope we get it right eventually. Okay, we take a break, and when we come back, stakeholders continue to have conversation over the land border closure. Do stay with us.